All right, so you've heard of venture capital, you've heard of private equity, but sometimes get confused as what they are and are they the same? Are they different? I get it. I get asked this question all the time. What's the difference between private equity and venture capital? And it's confusing because the truth is they're kind of the same, but then they're kind of totally different. And we'll dive in to help you understand that as part of this video. In this video, I promise you'll go from beginner to expert in understanding what venture capital is, what private equity is, how they're similar, how they're different, and look like a total genius at your next cocktail party. All right, so to understand private equity and venture capital, you really need to first understand what equity is. Now, simply put, equity is ownership in a business or a company, and it is typically represented by a security. Something that can be bought or sold, like common stock, preferred stock, even debt can be a type of security if it's like a note. So when I buy the security common stock in a company, I own a part of that company. And as an owner, I have a right to all future profits of that business. The idea of equity really traces its roots back. What would happen is you would have all these investors and they would put goods on these boats, and then the boats would travel to the West Indies and they would trade for goods, and then they would come back and they would offload their goods. And in order to make these work, oftentimes they would have multiple investors that would put money into these ventures, and they would set up companies to do that. And each investor could get equity or a piece of ownership of that boat. And this could be extended to different businesses. So maybe you set up a salt mine or you set up a farm and you took in dollars from investors. That whole system was built to provide a mechanism so that investors could put money in and have an ownership stake in the entity that was generating profits. That same concept continues today. So when I invest in a company, I am buying a piece of that company. And if that company goes to zero, my ownership in it is worth nothing. But if that company becomes the next Tesla, my ownership could be worth a lot of money. Really just tied to what people are willing to pay for that company, for that equity, that determines its value. And that value today is really going to be driven by the future value of what investors think it will be worth someday as well. And that's usually driven by the potential profits of the business, because equity at its most core is a right to the future profits of a business. So when a business generates profit, investors can demand to get their share of the profits based on their ownership of the overall company. Okay, now that we understand equity and what that's all about, let's talk about private equity. Now, private equity is confusing because it can ultimately kind of mean two things. The technical definition of private equity is kind of what it sounds like. It's equity that is private or privately traded. In other words, it's not equity that can be bought and sold in the public markets. You can't just open up your Robinhood account and trade those stocks. The stocks that you're able to trade in Robinhood are publicly traded, right? Anybody in the public can trade them. And private equity is equity that is held within private companies that aren't listed on a public exchange. In other words, it's a lot harder to buy and sell equities into private companies. You basically have to know the other owners of the business, then you have to negotiate with them on what's a reasonable price that they would be willing to sell at. And there are all kinds of regulations that have also been put in place to protect people when it comes to buying and selling shares in private companies. And this is because there were a number of fraudulent individuals that went around and said, hey, I've got this next, multi-billion-dollar idea, invest in my company. And then they would take the money and they would pocket it and they would disappear to another country. And because that kept happening, the federal government came out and said, you know what? Only people that are sophisticated or really wealthy and able to lose this money are allowed to invest in private companies. And so that created yet this other barrier that has made private equity investing very illiquid, right? You think about water as a liquid, right? It moves freely from one area to another. The same thing can be applied to investments. If I can freely trade and move my investment around in and out of a stock, then it is considered to be highly liquid. In private equity, they're less liquid because it's harder to move my investment in and out of a private company. In venture capital, that's even more so because if I invest in a company at the early stages, I may not get liquidity. I may not get paid back my investment plus a return, sometimes for 10 or 15 years, because it takes that long for these companies to grow to a maturity that a company would either want to acquire them or that they could go public. Private equity is just all equity that's private, that's not listed on a public exchange. But it's a little more nuanced than that, because when people talk about private equity in the Wall Street Journal or in Forbes or what have you, usually they're not referring to all private equities. All private equities would include seed stage, venture capital, growth equity, late stage. It would include leverage buyout, distressed buyout, distressed equity. It can include a lot of different things. It's pretty much a blanket statement for all equity that's private. But when the Wall Street Journal usually talks about private equity, they're actually referring to leverage buyout private equity, where a private equity firm is going and buying an entire company. These private equity funds, they're called leverage buyout funds because they're using debt to help finance the purchase of the overall company. And the reason for that is because debt can be this incredible tool to helping private equity investors, leverage buyout investors, generate huge returns. And today, the private equity industry is massive. It's hundreds of billions of dollars that have been allocated to these funds who are going out and buying companies of all sizes. Everything from like a chain of grocery stores on one hand that might just be a handful of stores, all the way to some of the largest businesses in the world have been acquired by some of the largest private equity funds. You think about deals like RJR Nabisco, which was a huge private equity deal done back in the 80s by KKR, were tens of billions of dollars. And today those deals still continue to occur. The beauty of using leverage in these deals is similar to buying real estate. So in some cases, you put down like 30% equity into a deal, you borrow the other 70%, you use the profits from the business to pay down the debt, and then without growing the business, without improving margins, without doing any of those things, you're able to double or triple your money. And then if you do make improvements to the overall business, you can generate 2, 3, 4, 5, 6 times your investment. What this means, though, is that private equity firms are usually investing in very profitable businesses with very stable, steady cash flows. Just like if you were to invest in real estate, you would want to buy an income-generating piece of property with steady rents. It's the same thing applies to businesses. You want to invest in companies that are generating strong cash flows that are pretty steady, so you have good visibility into that company's ability to continue to pay down the debt and generate your returns. Okay. Let's talk about venture capital funds, because venture capital funds are very different. Whereas private equity funds, what you want is a steady, boring business typically. In venture capital, you're looking for almost the exact opposite. You don't really care if they're generating strong, steady cash flows. In fact, if anything, that can be a negative. You want them spending money on growth, because in venture capital, you're looking for the future kingmaker, right? You want to back the next Google, the next Meta, the next Amazon, the next Apple, right? When it's a very small company, and you want to ride it all the way up to success. You don't want to just generate 2 or 3 times your money on an investment, or even 4 or 5. You want to generate 10, 20, even upwards of 100 or 1,000 times your investment on these companies. And the reason for that is because in venture capital, you're investing in companies you hope can get really big, but the likelihood of that happening is very low. And so as you're making investments, the reality is most of your companies are going to fail. And so you need those ones that do succeed to generate massive home run returns that make up for all of your losses and then some. So for venture capitalists, it's all about being able to predict the future. You're trying to look into your crystal ball and say, I believe the future is people traveling and staying in Airbnbs, right? Or it's, I believe electric vehicles are the future, and deciding that today when nobody else really can see that coming. And then you're going to invest in companies that are growing really fast, probably burning a lot of money, highly unprofitable, but growing fast so that they can take up market share and really establish themselves as the leader in their space. Venture capitalists almost never use debt. And when they do, the debt that they lend, they're really actually hoping it will eventually convert into equity. So it's not even really truly debt, not in the same way that private equity does. Hopefully now you can see why private equity and venture capital are kind of the same thing, but also kind of different. And hopefully this was helpful in understanding how the two are different. Ultimately, you have very different risk profiles and return profiles in both. In private equity, it tends to be more stable, but also lower returning. versus the potential of venture capital. I mean, there are numerous venture capitalists that have invested in one company and become billionaires from that one deal, whereas that almost rarely happens in private equity. The flip side is private equity, because it's a little more steady and safe, are able to raise much, much bigger rounds of capital and funds and are able to generate very healthy incomes off of those funds. If this video is interesting to you, be sure to check out my other video where I talk about what it's like to work in private equity.